Hey everybody, it's Abdullah Shamardi. We're going to do our weekly stock market review. Let's do it. Let's make some money. If you aren't subscribed to my page, make sure to hit that subscribe button, crush the like button for the YouTube algorithm, and check the link below to my Patreon. You'll get insights into my watch list, my portfolios, my daily readings, as well as instant buy and sell posts as I'm making them each and every day. Today we're going to be discussing the market again. As we all know, the market has been rough, especially on SPACs and tech over the past few weeks. The market in general is actually higher year to date. When we look at the S&P 500, we look at the Dow Jones Industrial Average, those indexes are still up year to date. Most of our portfolios are down because we've been invested in SPACs as well as tech companies, and those probably made the majority of our portfolios or a significant portion of our portfolios. And in many instances, some of us were concentrated on a few stocks in our portfolios, which have brought down our portfolios significantly because they were maybe at all-time highs or they continue to increase to new all-time highs. Examples are Tesla, DM, etc., where the stock has now come down from its all-time highs, maybe even to 50% of its all-time high. So this is one of the reasons why many of our portfolios are down compared to the larger indexes. We need to continue to invest in the market when it's going down. We shouldn't be scared and then be hungry when the market is going up. We should actually have the opposite personality and opposite strategy. We need to be able to be hungry when the market is down, and then we need to be scared when the market continues to go up and see which stocks we should actually trim and take some profits on. So we need to keep this in mind. I see a lot of people who are wanting to trim their positions when the market is going down, when in actuality, if you believe in the stock, you should actually be increasing your position on the stock, because now you're getting that same stock at a much smaller discount, 50%, 20%, 30%, etc. My next advice is don't use leverage to take advantage of the dip. Other YouTubers such as Meetkevin, they show live posts where they're using leverage in order to take advantage of the dip. These individuals have the opportunity and privilege to be able to do so because they have multiple revenue streams, whether it's real estate, sponsors, YouTube revenue, etc. So they have many ways to be able to cover any leverage if the market were to continue to go down. Whereas in many instances, us individual investors and retail investors that might be less privileged don't have that ability. If we were to take that margin, we lose it all, then we'd be out of the market. And in many times, the broker will take us out of the position that we were in. So don't use leverage. There are a few people that may use leverage and do well with it. However, for the most part, many individuals who use leverage get put in a bad spot and then they're having to leave their position. I don't recommend using leverage if you're don't have the ability to pay it back, as well as the ability to avoid the interest, and using it maybe potentially to take advantage of some daily fluctuations in prices. My other point is that big investors are hurting as well. Again, we saw another post from Chamath Palihapitiya where he shows all his SPACs and how much they're down year to date compared to where they were all-time highs. His week over week changes, so he's down 15 to 20% overall in his portfolio. So he's hurting as well as other people are hurting. But if you're invested in many of his SPACs, then you know that he's making smart decisions. He's investing in companies that he believes in. He's investing in companies that he knows will continue to grow. And as a result, if you have a wide range of his investments, you'll be able to grow your portfolio as he's growing his portfolio. And this is a short blimp in the stock market where it's taking a tremendous impact on SPACs, but that doesn't necessarily mean that those investments aren't worth it anymore. An example is DM is a position that I hold. I'm going to continue to hold, and now I'm actually looking into potentially increasing that position because the stock is trading at $15 now. My dollar cost average was at $11. So now it's getting close to what I had bought it initially, and now is the time to pounce and to be able to increase my investment, because at a certain point it was at $35 a share. So I have ability to potentially double my money, if not more. We also want to look at what these big investors are doing. So an example is Kathy Wood. She's selling her big tech positions in order to be able to gain on her positions in some of these upcoming technologies and upcoming markets, such as Fate Therapeutics, Tesla, etc. These stocks are selling at a discount, so she's gaining and increasing her positions. Emphasize again that SPACs can go under $10 if they're pre-merger. Many people have the misconception, oh, it's trading a little bit before $10. So maybe it can go below $10. This is just panic selling for people that might need to liquidate their position. So as a result, it trades under $10 for a short period of time. However, before the merger happens, the SPAC will offer the investor $10 plus interest. So no matter what, you'll have that opportunity to be able to sell that SPAC before the merger for $10 plus interest. However, it's a good buy to get it at $10. That's where the sponsor of the SPAC has bought the position. So it's showing that he has or she has confidence in the SPAC at that price point. So you're able to get it at almost the same price point at these moments, such as VGAC, which we saw trade almost at $10, which is merging with 23andMe, almost at $10 this past week, and you could have bought in it at $10, which is, again, when the sponsor of the SPAC had bought the position. Lastly, my advice is to continue to invest periodically in the market. Nobody knows when the dip is. Nobody knows when the bottom is. Nobody can predict it. If somebody's telling you that they can predict it, they're lying, or they're just trying to get more YouTube views. You're not able to predict when the bottom is going to be, and that's why you have to invest periodically, whether that's weekly, daily, monthly, every 2 weeks, whatever makes sense for you and your financial situation, is to always continue periodically invest in various positions and stocks that you believe in, so that you're getting the best average price instead of trying to time the dips, because we've seen from research that timing the dips never works, and investing periodically is the best method to dollar cost average and get the best price on each position that you have. So these are my thoughts from the past week. Let me know what you think. As always, make money, enjoy life, peace.